Hey everybody, my name's Joe Pivarunas. I'm the founder and managing editor of Nanalyze. We're a boutique media and research firm that covers disruptive tech investing for a broad audience of retail and institutional investors around the globe. Today we're going to talk about a company called Amyris, and the title of this slide says Lipstick on a Pig. So I was looking at our metrics right before this call, and it appears that 99.6% of our audience are male. So we're going to be talking a bit about beauty products today, but we'll try to make it interesting. Now, in the same token, in looking at our metrics, about half of our audience is from the United States. The other half are from abroad. So we might want to put some color around this term. It's not a reference to Tess Holliday. It's a term used in the UK and the United States to talk about how some companies will have a product or service or platform that's fundamentally flawed, and they'll try to make some cosmetic changes so that it doesn't appear flawed, when in fact what's underlying the cosmetic changes is something that can't be fixed. So in that context, we're going to look at Amyris, and in particular the work they're doing towards moving the company in the direction of beauty products. Now, when we looked at Amyris back in June 2021, we said the following. We applauded the vision of SynBio, this grand production platform that can produce all these cool things in across industries, so it would be industry agnostic. And Amyris certainly had the potential to do that, but there's enough red flags for us to avoid the stock going forward. And since we last checked in with the company, the share price has fallen over 70%. Now, trying to figure out why a share price falls in such a short time frame is very difficult, but what we can figure out is whether or not this is a company we would want to hold at any price. So Amyris started 2021 out with 3 products: Biossance, which was a skincare product, a clean baby skincare product called Pipette, and then Purecane, a 0-calorie sweetener. And you look at these products, and they're not very compelling. So that vegan skin cream for $65 a tin there seems kind of rubbish. This Look Awake eye gel for babies, so babies are always look like they're sleeping anyway. Just pointless stuff, right? And then of course this Purecane, keto-friendly, vegan, no-calorie sweetener. So, not very compelling to begin with. And when you can go to look at these products, you'll see that they have product lines, and they're being sold direct to consumer. Well, what happened in the latter half of 2021 was that Amyris then launched 5 more beauty brands for whatever reason. So we believe it's a venial sin for companies to try and develop and sell their own products, right? So if you're a synthetic biology company, then that's what you should be focused on: bettering your platform, having, taking all that big data and having data scientists go through and figure out how to use it, and honing your machine learning algorithms, and using gene editing, and having scientists and PhDs working on making this platform better and better, not trying to sell your own beauty products. We think that it's a mortal sin when companies then decide to get into the FMCG products space. So the other thing that Amyris did throughout the year was they acquired 4 beauty companies. So for whatever reason, they spent $161 million on these firms. 3 appear to be selling, overpriced beauty products, and then one is a digital marketing agency in London. And then this is a big red flag: provides influencer marketing. So, they're overpriced and that you're not getting any value out of their service. Now, in looking at the 10K, which is where we drove all this information from, there are other things that are concerning as well. So Amyris has about $700 million in debt that's due in 2026. And what they ought to be doing is looking at how they can reduce costs and start operating more lean, but they're doing anything but. So sales, general, and admin increased by 88% to $257 million in 2021. So that's almost half of their operating expenses. And the increase was due to sales and marketing expenses related to those consumer brands, an additional 295 employees, and they said mostly within sales and marketing consumer brand teams. Is that what we want this great synthetic biology company to do? So for the last 20 years, and after spending $2.4 billion, is this the grand vision investors had hoped for? Probably not. to make matters worse, they've entered into leases in three of the most expensive property markets in the world. Now, New York, maybe not Miami, but certainly New York and London, and they're going to be used as office and retail space for their consumer business. It's just rubbish. Now, the bulls will point to, and they commonly do, the John Doerr relationship. So this is a very notable VC who has backed the company for a while. He's one of three significant stockholders. And to put that into context, this gentleman's net worth sits at around $12 billion. So even if he owns 20% of the company, and he did at one point, but guess what? They're issuing shares so fast that he's probably been diluted all to hell. But even if he still owns 20% of the company, it's 2.4% of his net worth. All right. So it's not a very significant piece of his wealth. And to put this in context, we've provided a number of bullet points here that show, depending on what sort of money you're investing, how that looks at 2.4%. It's always important to consider things relative, right? So one person's big portfolio is a very small to another person. So when we talk about this gentleman who's been involved in the company for a long time, the ultimate goal of any business is to survive. All right. And going through that 10K, which is extremely convoluted, this is a very difficult business to understand. And going through that, you're led to believe that there's very favorable terms being given to key stakeholders in the company, as you would expect. So he certainly wants the business to survive, and that's what he's in it for. And you don't know the reasons why key investors stick around with companies like this, but we don't care, because what Mr. Doerr does in his billionaire world is a lot different from what we do. So when you look at the number of shares outstanding for this company, they've just been going through the roof over the past 5 years. So that's 6 times over in the past 5 years. That's dilution. Most retail investors don't pay attention to share dilution because they're just not watching these numbers, and they damn well should be. So the other thing that is a concern when you look at, and again, something that isn't so obvious when you look at Amyris, is where the revenues are coming from. So remember, we said three parties owned more than 30% of the company. Well, one of those is a firm called DSM. Well, the orange bars you see here, that's revenue coming from DSM to Amyris, and it's referred to as related party revenue. Why? Because DSM happens to be an investor in Amyris, and this is similar to when we look at Ginkgo Bioworks, and we see, well, Ginkgo Bioworks created all these startups, they funded the startups, and then the startups gave them back the money, and they recorded it as revenues. So related party revenues can be very tricky, and they usually disguise some sort of money changing hands that doesn't really reflect the sort of revenue growth that we want to see. So we discount that when we look at firms. Now, the good part here is when you look at the normal revenues for this company, they appear to be having some consistent growth, and that's great. But the fact that there's such a large percentage of related revenue in 2021 coming from a single customer is customer concentration risk, and it's a concern. So when you look at Amyris's revenue progress, we believe that you should back out related party revenues. Now, another good thing going for Amyris is their relationship with this makeup company, Sephora. And you can see this growth of revenues over time. So why not, work on that relationship? Let them do what they do best, which is to sell beauty products. Again, how much value are you adding by improving the beauty industry? That's a $500 billion industry that's viciously competitive and fickle. The consumers who half the world cares about that stuff, and the consumers who buy that stuff don't really care if you're using some great synthetic biology platform to produce it. They care about what Muppet on television was showing them the latest cool thing that they ought to buy, which will make them look 10 years younger. So, what they say, right? They say women fall in love with what men say, and men fall in love with how women appear, which is why women wear makeup and men tell lies. So this whole thing is not adding a lot of value, and we don't believe that Amyris should be in the business of developing beauty products. Vertically integrating a SynBio platform where you try to invent and then you try to produce and you try to sell and market is far too capital intensive. And it's really confusing as to why Amyris thinks this is something that's the way forward. An Intel Inside model is preferred. So Ginkgo, of the firms that we've looked at, so the big four would probably be Codexis, Ginkgo, Zymergen, and Amyris, right? Of those, Ginkgo has the most desirable business model. They're getting foundry revenues up front, and then they have downstream revenues. The problem with Ginkgo is that they were overpricing those downstream revenues. And when we wrote about that, I can't recall what the price of the shares were at, but we had set a price target of around $2.69 when the foundry revenues would make it worth starting to look at. Well, it's going to approach that price. So one of the things that we have to do is when they put out their 10K, they only put out an 8K, short 8K, talking about what they expected for 2021, but we want to see the formal 10K so we can dig through it and get some insights. We'll revisit Ginkgo. As for Amyris, there's nothing to see here. The direction they're going is certainly not something we want any part of. If we thought beauty products were the way forward and we wanted to find companies that were innovating in that area, even then we wouldn't invest in Amyris because you have all these other problems: related party revenues, heavy debt load, customer concentration risk, excessive spending. The company's been around for almost 2 decades. They spent $2.4 billion, and where they've ended up just isn't cutting it. So it isn't a company we think any risk-averse investor should be considering. So we'll leave it at that. If you have any questions or comments, please just put them in the comment section on this video. Make sure you subscribe to our channel, and thanks so much for taking the time to listen to this presentation today.